Hello, welcome to Chapter 17, Express Notes, hopefully the last recording, inheritance tax and VAT. So, inheritance tax first, the big picture. What is inheritance tax? Well, it's chargeable upon death of an individual. So you're going to look at the value of the estate of somebody at death. Now, the charge occurs, obviously the death of an individual, but you also look back 7 years at lifetime gifts, things that are given away in the previous 7 years. They need to be looked at as well. Now, something to think about is the amount of a transfer of value is based on the fall in the value of the donor estate. Clearly people give things away and you need to work out how to value that transfer. So, example, a market value of 2% shareholding in a company will be lower than the fall in value for an individual that owns 51% of the company and sells 2%, because basically they've lost their controlling interest. So something you need to think about when doing valuations of assets. So in other words, if you have a 4% holding in a company and you go down to 2%, that is a completely different valuation from 51 to 49. Chargeable property represents property that a person owns or is entitled to, and unlike CGT, there is no exempt assets for IHT purposes, so everything is in your estate upon your death. For the purposes of the FCA exam, a chargeable person will be somebody who is UK domiciled, and therefore you're liable for IHT on all your worldwide assets. So don't just think about them being situated within the UK. They could well be situated in Romania, South Africa, Holland. It doesn't matter. They're all part of your estate if you're UK domiciled. Domicile being basically the country of your birth. So when it is inheritance tax chargeable, as I say, it's upon death. It's also on certain lifetime transfers. We'll come to that in a second. So on death, the main incursion obviously is when you die, and the rate of tax is charged on anything that's above the exempt band limit, which varies from year to year. Lifetime transfers. There are 3 types of transfers you can make during your lifetime. There are exempt transfers, which is where you make small gifts to an individual and they are exempt. Exempts from IHT all the way through. Right, potentially exempt transfers are where you make a gift to an individual. There's no IHT payable at that point in time. If the donor lives for 7 years, then it still remains exempt. However, if the donor dies within 7 years, the potentially exempt transfer becomes chargeable to IHT. It becomes part of their estate. Chargeable lifetime transfers can be will be basically for F6 all gifts into a trust, so they are charged to IHT at that point when they're transferred. However, this bit here becomes irrelevant. There's no further IHT to pay because you've paid it at that point. On death, within 7 years, possible extra IHT to pay, depends on the situation. Now, we talked about exemptions. Basically, the exemptions are small gift exemption, less than 250 per recipient per year, per tax year. So don't remember, tax years end every 5th of April. Annual exemption, 3,000 per year. Can be carried for 1 year and 1 year only if it's not used. But if you don't use it, it is lost. You can give away money that's beyond your habitual expenditure. So it's kind of like if you earn this amount but put money aside to save, you can use that. There's also a marriage exemption, so if you are parents, you can give to your children upon their marriage up to £6,000. Transfers between spouses are also exempt from IHT. How do you calculate IHT? Well, what you do is you add up all your transfers of value, less any exemptions, give you a chargeable amount. You basically add all your estate above the nil rate band, which for 2011-12 is 325. So like for an individual, who earns money, you have a personal allowance of 7,475. For inheritance tax, the first 325,000 of your estate is nil, and then that amount above that is chargeable to IHT. What is the rate of IHT? Well, it depends who pays the tax. If the recipient pays the tax, i.e. the trustees, donee, the gift is referred to as gross gift and the tax rate is 20%. If the transferor pays the tax, i.e. the donor, the gift is referred to as a net gift and the tax is now 25%. Broadly speaking, tax on transfers will be taxed at 40%. That is the IHT rate. There is, however, when you've got this 7-year you're looking back to before death, there is a consideration about taper relief. Clearly it would be a bit unfair to tax it all at 40% if someone died 6 to 7 years ago. So what you do is you say, well, okay, 80% of the tax due is mitigated, is reduced, and then on a sliding scale back to less than 3 years before death, there is no tapering of the tax, so the full 40% will hit on any gift that was made within the 3 years before death. Basically what that's saying is you can't just give away all your assets the day before you die and avoid inheritance tax. So that's how inheritance tax works. So you got your 325,000 nil rate band, and then you've got this tapering above that, upon which you pay 40% tax, but it's mitigated by these percentages on a sliding scale working backwards. So the longer you give away your assets, up to 7 years, the less tax your estate will have to pay. Okay, that's inheritance tax. We'll now go to VAT in the next recording. Actually, sorry, there's one more page to go. Let's do an example. Death after a lifetime transfer. John made a potentially exempt transfer of $350,000 on the 10th of January 2008. He died on 10th of April 2011. He made no other lifetime transfers. The death occurred in obviously 11/12 when the nil rate band was 325,000. IHT due on 25,000 is 40%. 25,000 times 25,000 is £10,000. Taper relief, because it's between 1 and 3 to 4 years, is 20%. So you knock off 20% of the tax to give you 2, and then IHT due after taper relief is 8,000. Calculation of IHT at 40% on the estate at death is looked at after the lifetime transfers have been dealt with. So in other words, this potential exempt transfer has used all the nil rate band. So if someone also had a house, cash, car, etc., they would all be taxed now at 40%, because the nil rate band's being used up here on the potential exempt transfer from 3 years ago. So anything this person owns, who was it? It was John. John's estate's all going to be taxed at 40%. Okay, and that's how you do inheritance tax. Okay, now is the end of the chapter, and we can now go to VAT in the next recording.